Howdy folks, Mitchell Kuhn with Wisdom Financial here. I wanted to take a few minutes explain to you what you need to know about this current junk bond bubble going on right now and how it's going to impact you and what you can do about it. So simply explain, junk bonds are money loaned to companies that have higher risk. Typically they have to pay higher interest rates because their credit is not as good as comparable companies. So let's compare it to an example of someone who's going to go buy a car. If you have lower income and a history of defaulting on your bills, then you're going to pay a higher interest rate. So there are companies that don't have as strong of financials, so therefore when they borrow money, they pay higher interest rates. So these are also known as high yield bonds. Interest rates have been very, very low since 2008. So investors have gone looking for a way to get decent yields to fund their retirement. So the 10-year treasury now is paying about 1.7%, so that's not even barely covering inflation. So people start reaching for yield. They start looking for where they can get higher rates of returns. So it's become very popular to go into more higher risk bonds, oftentimes junk bonds, also called high yield bonds. So because of this, you may own junk bonds and not know it, or they may have more risk than you realize. So a little history lesson here. The very same thing happened back in the 2000s in the run-up with the housing crisis that happened in 2008 to 2009. So investment bankers wanted to create products that provided higher yield for investors. And so they took riskier mortgages, people that didn't have very good credit, that should have never got the money in the first place to buy these houses, and they packed these mortgages into different investments that they sold to the public. So if you haven't seen the movie The Big Short, I highly recommend it. It's a great demonstration of what happened and is surprisingly accurate when I watched it. So if you do want to see it, I suggest watching it on a website called Vid Angel. It allows you to watch a PG version. We can cut out all the nonsense and just focus on the actual storyline. So a very important lesson is learned through this movie, and that was that investors did not fully understand the risk they were taking in mortgage-backed securities leading up to the housing bust. And the interest rates that were being paid prior to 2008 and 9 were not enough to compensate investors for the amount of risk that they were actually taking in these investments. So it came out after the fact that a lot of the banks and the rating agencies weren't being forthright on how much risk was in these investments. And a lot of this was due to fraud. So Goldman Sachs was recently reached a settlement to pay about $5 billion related to misconduct during the housing crisis. Overall, the financial industry has paid over $40 billion as punishment for their sins, for the things that they did that caused much of this bubble and much of the collapse. So here's a quote from a Zero Hedge article. It says, "This resolution holds Goldman Sachs accountable for its serious misconduct in falsely assuring investors that securities it sold were backed by sound mortgages, when it knew that they were full of mortgages that were likely to fail." This was said by the Acting Associate Attorney General Stuart Dellery. So a very similar problem is going on today in the high yield market, the junk bond market. The 2008 housing bubble was caused by loaning money to individuals who bought homes that they really couldn't afford them. And most of these mortgages were sold with adjustable rates. So what happened is, as they were first issued, people could afford the payments. They were very low because the rates were low. Once the rates adjusted up, people couldn't afford the homes that they bought, and they started to default. So to help the economy recover from this financial crisis, the Federal Reserve drastically lowered interest rates and printed mountains of money to help the economy recover from this crisis. Well, billions of dollars were loaned to many different companies at very low rates. Oil companies borrowed a lot of this money. Many different companies and countries all over the world borrowed in the dollar at these very low interest rates. So back in 2008, or leading up to since 2008, oil prices have been between about $80 and $100 per barrel of oil most of the time. There was a brief dip in '09 where it got down below 80, but then it's been up back above that ever since. So when these companies borrowed this money, oil prices were much higher. And now prices have plunged below $40 a barrel. So what do you think is going to happen when these oil companies go to try to refinance their debt and oil is half the price it was when they took the loans out the first time? Well, the rates are going to skyrocket. They're going to go up. The companies don't look as good, so their ratings are going to go down. Their financials aren't as strong. So just common sense tells you they have to pay higher rates. So what happens when companies pay higher rates? It drives the prices of the bonds down. And we'll get to that in a second. So the problem is not only isolated to oil companies. Earnings are down pretty much across the board. And we've even seen Q1, they're starting to come out, Q1 2016 earnings, and they're not looking much better. They're still showing negative earnings growth. So there's a nice chart here that shows us that the S&P overall, the top 500 companies in Q5 were down 5.6%. Probably going to be worse than that in Q1 2016. Energy was down 80% in Q4 of 2015. So when earnings go down, lenders require a higher interest payment to compensate them for this risk. The million, or should I say the billion-dollar question is, are investors today being compensated for this higher risk that's coming along with lower earnings and with lower oil prices? So I was reading this article today on Bloomberg.com, and it says, investors that lend to U.S. junk-rated companies are not being compensated for the looming credit shakeout that could push defaults to record highs, according to UBS Group AG credit strategists Matthew Mish and Stephen Caprio. They go on to say that a slowdown in U.S. growth could cause the bubble to pop, stressing the lower quality companies that constitute almost half of the universe of the speculative grade bonds and loans. So speculative grade bonds, junk bonds, high yield bonds, all the same thing. You're loaning money to companies that are in more precarious positions because you get higher rates of return. So when earnings continue to go down and we get to the time where this refinancing is going to take place more and more, you're going to see pressure on these companies, and it's going to hurt the high yield bond market. So what does this mean for you, the investor you're trying to plan for retirement? The bubble cannot go on forever. So just like in 2008, the markets will wake up to the risks that these companies have, and they're going to properly price for the risk at hand. And this is going to cause the yield, the interest rates these companies have to pay are going to go up, which is going to drive down the prices of all the high yield bonds already out there in the market, because the new ones are paying higher rates. And it's going to push the prices down pretty significantly. So why is this important for you? Well, the high yield bond market is a very good leading indicator of the stock market. We've often heard it said that the bond market is the dog and the stock market is the tail. So when the bond market starts to go down, the dog wags the tail. You often see the stock market almost always following the high yield bond market. So what do you think's going to happen next? Well, I'm going to let Stephen Caprio from UBS tell you. He says the bubble may not burst this month, but when it does, it will create a lot of losses for everyone who's crowded into corporate credit. So corporate credit is loaning money to companies, and especially in the high yield corporate space, the junk bond corporate space. The same thing happened in 2008. It was just mortgages that time, and now it's companies. So no one can tell you exactly when or how much the markets are going to go down. We can look at general trends in the economy. We can look at the underlying factors, and we can have some idea of kind of what season we're in. So the best thing to do is to understand the risk in your current portfolio and look for strategies that can help protect you when a major market downturn comes. So just ask yourself, how did your portfolio do in 2008? What did your advisor or your money manager do to protect your hard-earned savings? Are you happy with how it performed? Do you have the time, if the market were to go down again significantly, to re-earn that money before you retire? One of my biggest concerns over the next 10 years is with these kinds of debt loads, returns are often subpar. We may not have as robust of a recovery as we did back in 2008. We've already had negative interest rates for 8 years. We've already had quantitative easing and money printing. So how much lower can rates go? Well, they can go negative. That'll be the topic of another blog post for another time. So what can you do? Well, we have a powerful tool. We've partnered with a company called Riskalyze. They're winning all kinds of awards. Their core technology is based on the academic framework that won the Nobel Prize for Economics in 2012. And this tool lets us load in your exact portfolio if you have mutual funds, ETFs, stocks, bonds, whatever it is. And it gives us a very simple risk number between 1 and 99. 78 represents the risk of the S&P 500. Most retirees want less risk than the S&P 500. And we can show you exactly in a quantitative way what the risk is in your portfolio. And we can give you some options. If you want to consider reallocating, we can show you other ways, other management strategies to reduce that risk and volatility. So I've got a link here in the blog post below where you can click on that link and take the online risk quiz. It only takes about 5 minutes. And then you can contact us and we can load in your current portfolio exactly and let you know if your portfolio matches your risk tolerance in that quiz that you take. So please give me a call, send me an email. I love helping people reduce risk and volatility in their portfolios. I like nothing more than seeing people have more secure retirements for themselves and for their families. I give away a lot of free advice. If you just give me a call or shoot me an email, whatever it is, if you ask me a question, I'm going to answer it. So give me a call and find out for yourself how much I'm just willing to help you. So until next time,